Welcome to another exciting episode of Full-Time Hustler. I'm your host, Jason Feimster, and today we're diving deep into one of the most crucial aspects of building a successful startup, finding and approaching investors. Now, I know what you're thinking. Finding the right investors can feel like searching for a needle in a haystack, but trust me, it's possible, and I'm here to guide you every step of the way. Let's face it, securing funding is often the most daunting challenge for entrepreneurs. The sleepless nights, the countless revisions of business plans, the fear of rejection. We've all been there. But here's the thing. Every successful entrepreneur, every thriving startup has faced these exact hurdles and pushed through. It's about perseverance, preparation, and knowing where to look and how to present yourself. In today's episode, we're going to break down the entire process into manageable steps. We'll explore how to understand the investor landscape, research potential investors, craft a compelling pitch, and make that all-important first contact. We'll delve into strategies for building relationships with investors and preparing for meetings, and finally, we'll cover the art of closing the deal. But this isn't just about tactics and strategies. It's about changing your mindset. It's about realizing that investors aren't mythical creatures hiding in the shadows. They're real people looking for opportunities to grow their wealth and make a difference. And your startup, your vision, could be exactly what they're looking for. We'll also hear from founders who've been in the trenches, who faced the same struggles and emerged victorious. These stories will inspire you, and the practical tips will equip you with the tools you need to succeed. So if you're ready to take your entrepreneurial journey to the next level, grab a notebook, get comfortable, and let's get started. This is Full-Time Hustler, and today we're unlocking the secrets to finding and approaching investors. Let's do this. All right, so you're ready to dive into the world of investment. Before you start making your pitch, it's crucial to understand the landscape of potential investors out there. Knowing who they are, what they're looking for, and how they operate can give you a significant edge. Let's break it down. First up, we have angel investors. These individuals are often the unsung heroes of the startup world. Angel investors are typically high net worth individuals who provide capital to startups at the early stages, often when the business is just an opportunity or a prototype. They are called angels for a reason. They take on high risk with the hope of high rewards. According to the Angel Capital Association, there are over 300,000 active angel investors in the U.S., collectively investing about $25 billion annually. Think of angel investors as your startup's first believers. They're looking for innovative ideas, passionate founders, and the potential for substantial growth. What's more, they often bring invaluable experience and mentorship to the table. Next, let's talk about venture capitalists or VCs. If angel investors are the early believers, venture capitalists are the powerhouses that can supercharge your growth. VCs manage pooled funds from many investors to provide substantial amounts of capital to startups with high growth potential. They usually invest in later stages when your business has demonstrated some traction and has a scalable model. The National Venture Capital Association reports that venture capitalists invested a whopping $130 billion in U.S. startups in 2020 alone. Venture capitalists are looking for businesses that can grow quickly and provide significant returns on investment. They're not just investing in ideas, they're investing in execution. So when you're pitching to VCs, be prepared to show solid evidence of your market potential, revenue model, and growth strategy. Then we have private lenders. Unlike angel investors and VCs, private lenders provide loans rather than equity investments. This means you won't be giving away a piece of your company, but you will need to pay back the loan with interest. Private lenders can be an excellent option if you have a clear plan for generating revenue and prefer to maintain full control over your business. These lenders are particularly interested in your ability to repay the loan. So, a strong financial plan and cash flow projections are critical. Understanding these different types of investors is the first step in targeting the right ones for your business. Each type of investor brings different resources and expectations, and aligning your approach with the needs can significantly enhance your chances of success. But let's not forget, investors are more than just sources of money. They can be partners, mentors, and advocates for your business. Building a relationship with the right investor can open doors to new opportunities, provide valuable industry insights, and help you navigate the challenges of scaling your business. So take the time to understand the investor landscape. Do your research, know who you're talking to, and tailor your approach accordingly. Remember, it's not just about finding any investor, it's about finding the right investor for your vision. This understanding will be the foundation upon which you build your strategy for approaching and securing investment. In the next segment, we'll dive into how to identify potential investors who align with your business goals and values. Stay with me, and let's keep this momentum going. Now that we've got a good understanding of the investor landscape, it's time to roll up our sleeves and get into the nitty-gritty of researching potential investors. This step is crucial. It's where you begin to match your startup's unique needs with the right investors who can help you achieve your vision. Let's dive in. First, identifying the right investor starts with a clear understanding of your own business. What stage are you at? Are you just starting out, or do you already have some traction? What industry are you in? And what kind of funding do you need? Answering these questions will help narrow down the list of potential investors who are a good fit for your business. One of the best ways to start your search is by using online platforms and databases specifically designed for this purpose. Websites like AngelList, Crunchbase, and PitchBook offer extensive directories of investors, including their investment preferences, past investments, and contact information. These tools can save you a ton of time and provide valuable insights into who might be interested in your startup. For instance, AngelList allows you to filter investors based on their industry focus, investment stage, and location, making it easier to find those who align with your needs. Another valuable resource is your own industry network. Attend industry events, conferences, and startup meetups. These events are not only great for networking, but also for gathering intelligence on who the key players are. For example, TechCrunch Disrupt and Web Summit are renowned for bringing together a plethora of investors and entrepreneurs. Don't just attend these events, engage with speakers, participate in panels, and make the most of networking opportunities. Often the best leads come from personal connections and recommendations. Speaking of recommendations, leverage your existing network. Reach out to mentors, advisors, and other entrepreneurs who have successfully raised funds. Ask for introductions to investors they trust and have worked with. Personal referrals can go a long way in building credibility and opening doors that might otherwise remain closed. LinkedIn is another powerful tool for researching investors. Use it to find mutual connections and get introductions. LinkedIn also allows you to see professional background of investors, including the companies they've invested in and their areas of interest. Craft a professional and compelling LinkedIn profile that highlights your startup's achievements and vision. This not only attracts potential investors, but also makes it easier for them to find you. Don't forget about local resources. Many cities have startup incubators, accelerators, and entrepreneur groups that can connect you with local investors. Organizations like Y Combinator, Techstars, and 500 Startups have vast networks of mentors and investors who are actively looking for new opportunities. Joining these programs can provide you with invaluable mentorship and a direct line to potential investors. As you research, create a targeted list of investors who align with your business. Look for investors who have a track record of investing in your industry and at your stage of development. Study their past investments. What kind of companies do they invest in? What do these companies have in common with yours? Understanding an investor's portfolio can give you insights into their investment strategy and help you tailor your pitch. Remember, this isn't just about finding investors. It's about finding the right partners who believe in your vision and can provide more than just capital. They should bring valuable insights, industry connections, and mentorship that can help your business grow. In the next segment, we'll discuss how to craft a compelling pitch that captures the attention of these investors and sets you apart from the competition. Stay tuned and let's keep building towards your success. All right, we've identified the right investors, and now it's time to craft a pitch that not only captures their attention, but also convinces them that your startup is worth investing in. Crafting a compelling pitch is both an art and a science. It's about storytelling, precision, and connecting on an emotional level. Let's break it down. First things first, your pitch needs to tell a story. Investors hear countless pitches, so yours needs to stand out by resonating emotionally and intellectually. Start with your why. Why does your startup exist? What problems are you solving, and why does it matter? Simon Sinek's famous TED Talk on starting with why emphasizes this beautifully. Your passion and vision should shine through right from the beginning. For example, if your startup is developing a new app to help people manage their mental health, share a personal story or a compelling statistic that highlights the importance of mental health and why your solution is needed. Next, clearly define the problem. Investors need to understand the pain point you're addressing and its magnitude. Use data and real-world examples to illustrate the problem. For instance, if you're tackling the issue of food waste, you could cite a statistic from the Food and Agriculture Organization that approximately 1/3 of all food produced for human consumption is wasted each year. This sets the stage for why your solution is crucial. Once the problem is clear, introduce your solution. Explain how your product or service addresses the problem in a unique and effective way. Highlight your unique selling proposition. What sets you apart from competitors? For example, if your startup uses AI to reduce food waste by optimizing supply chains, explain how your technology works and why it's better than existing solutions. Use visuals, demos, or prototypes to make your solution tangible and engaging. Your business model is another critical element. Investors want to know how you plan to make money. Outline your revenue streams, pricing strategy, and any significant partnerships or customer contracts. Be realistic and honest about your financial projections and how you plan to achieve them. For example, if you have a subscription-based model, provide details on your pricing tiers, expected customer acquisition costs, and projected lifetime value of a customer. Market opportunity is a key factor for investors. They want to invest in startups with significant growth potential. Provide data on your target market size, growth trends, and your potential market share. Use credible sources and be specific. For instance, if you're entering the mental health app market, you could cite a report from Grand View Research that estimates the global mental health app market will reach $3.9 billion by 2025. Team is everything. Investors bet on people as much as they bet on ideas. Highlight the strengths and expertise of your team members. Share their backgrounds, relevant experience, and any notable achievements. If you have advisors or board members with impressive credentials, mention them too. Investors want to know that you have the right people to execute your vision. Financials and traction are crucial. Provide an overview of your financial performance to date, including any revenue, user growth, and key milestones. Show metrics that demonstrate progress and potential, such as customer acquisition rates, retention rates, and any significant partnerships or pilot programs. If you've won any awards or received media coverage, highlight these as well. Finally, make your ask clear. Specify how much funding you're seeking, what you plan to use it for, and the expected impact on your business. Break down your use of funds into categories such as product development, marketing, hiring, and operations. This shows investors that you have a clear plan for their money and how it will drive growth. In summary, your pitch should weave together a compelling narrative that highlights your startup's potential, backed by data and a clear plan for success. Practice your pitch until it's smooth and confident, but also be prepared to adapt it based on feedback and the specific interest of each investor. In the next segment, we'll discuss the best strategies for making initial contact with investors and ensuring your pitch gets noticed. Stay with me, and let's keep this momentum going. You've done your homework and crafted a compelling pitch. Now it's time to reach out and get your pitch in front of the right investors. Making that initial contact can be nerve-wracking, but with the right strategies, you can maximize your chances of getting noticed and securing a meeting. Let's dive into how you can make a strong first impression. First and foremost, personalization is key. Investors receive countless emails and messages daily, and a generic outreach won't cut it. Take the time to research each investor thoroughly, understand their investment history, interest, and recent activities. When you reach out, reference specific investments they've made and explain why your startup aligns with their portfolio. This shows that you've done your homework and are genuinely interested in partnering with them. Crafting the pitch perfect introductory email is an art. Start with a compelling subject line that grabs their attention. Something like, innovative AI solution reducing food waste, seeking partnership, can pique their interest. In the body of your email, keep it concise but informative. Introduce yourself and your startup in a few sentences. Highlight your unique value proposition, and clearly state why you believe they would be interested in your business. For example, hi, investor's name. I'm Jason Feimster, founder of your startup. We're developing an AI-driven platform that reduces food waste by optimizing supply chains. Given your recent interest in similar company, I believe our solution aligns perfectly with your interest. We've already partnered with key partner and have seen a percentage reduction in waste for our pilot users. I would love the opportunity to discuss how we can work together to make a significant impact. Best regards, Jason. Remember to attach your pitch deck and include a call to action, such as requesting a meeting or phone call. Keep your email short and to the point. Investors are busy and appreciative of brevity. Social media is another powerful tool for making initial contact. Platforms like LinkedIn and Twitter allow you to engage with investors more casually. Start by following them and engaging with their content. Comment on their posts, share relevant articles, and build a rapport over time. Once you've established some level of interaction, send a direct message that references your prior engagements. For example, hi, investor's name. I've enjoyed following your insights on LinkedIn, particularly your recent post about sustainable tech investments. I wanted to reach out because my startup, your startup, is addressing food waste with an AI-driven solution that I believe aligns with your interest. I'd love to connect and discuss this further. Best, Jason. Networking events and industry conferences are also excellent opportunities for making initial contact. These settings provide a more personal touch and allow for real-time interaction. When attending events, be prepared with a quick elevator pitch that clearly articulates your value proposition. Practice it until it feels natural and confident. Don't just focus on investors. Engage with other entrepreneurs, mentors, and industry professionals who might introduce you to investors. Leveraging mutual connections can significantly increase your chances of getting a response. If you know someone who has a relationship with the investor, ask for an introduction. A warm introduction from a trusted source can carry much more weight than a cold email. Be respectful and considerate when asking for introductions. Explain why you believe the investor would be interested and how it aligns with their focus. Persistence is important, but there's a fine line between being persistent and being pushy. If you don't hear back after your initial contact, Follow up after a week or two with a polite reminder. Highlight any new developments or milestones that have occurred since your last message. For example, hi, investor's name. I wanted to follow up on my previous email regarding your startup. Since I last reached out, we've secured a partnership with new partner and achieved a new milestone. I believe these updates further demonstrate our potential and would love to discuss how we can work together. Best regards, Jason. Lastly, always be prepared. When an investor responds and expresses interest, be ready to provide additional information, answer questions, and schedule a meeting promptly. Your responsiveness and professionalism can leave a lasting impression and set the tone for a productive relationship. In the next segment, we'll explore strategies for building and maintaining relationships with investors once you've made that initial contact. Stay with me, and let's keep pushing forward on your journey to securing investment. Great job! You've made initial contact with potential investors. But the journey doesn't end there. In fact, it's just beginning. Building and maintaining strong relationships with investors is crucial for securing funding and ensuring their ongoing support. Let's explore how to nurture these relationships and keep investors engaged. First and foremost, authenticity is everything. Investors want to work with entrepreneurs who are genuine, passionate, and trustworthy. Be yourself. Be honest about your business's strengths and weaknesses, and show that you're committed to your vision. Authenticity builds trust, and trust is the foundation for any strong relationship. Communication is key. Keep your investors in the loop with regular updates about your progress, challenges, and milestones. This doesn't mean bombarding them with constant emails, but rather providing meaningful updates that show your business is moving forward. Consider sending a monthly or quarterly newsletter that highlights key achievements, new partnerships, revenue growth, and any strategic changes. Transparency in both good times and bad times is crucial. If you encounter setbacks, don't shy away from sharing them. Investors appreciate honesty and a proactive approach to problem solving. Another effective way to build relationships is by seeking advice. Investors often have a wealth of experience and knowledge that can be invaluable to your business. Don't hesitate to ask for their input on strategic decisions, product development, or market expansion. This shows that you value their expertise and are open to learning. It also keeps them actively engaged in your business. For example, if you're considering a pivot in your business model, reach out and ask for their perspective. A simple message like, "I'd love to get your thoughts on this new direction we're considering," can go a long way. Personal connections matter. Take the time to get to know your investors on a personal level. Learn about their interests, passions, and what motivates them. This can create a deeper bond beyond the business relationship. If you're local, invite them to company events, lunches, or casual meetups. If they're not local, virtual coffee chats or video calls can still foster personal connections. Showing genuine interest in them as individuals can strengthen your relationship. Networking is not a one-way street. As you build relationships with investors, think about how you can add value to them as well. This could be through introductions to other entrepreneurs, sharing industry insights, or offering to help with their portfolio companies. When investors see that you're willing to contribute to their success, they're more likely to reciprocate and invest in yours. Respect their time. Investors are busy people, and respecting their time is crucial. Be concise and to the point in your communications, and always come prepared for meetings. Have a clear agenda, provide necessary documents in advance, and follow up with a summary of the discussion and next steps. Demonstrating professionalism and efficiency can leave a positive impression. Follow through on your commitments. If you promise to send a report, update on a milestone, or follow up on a discussion point, make sure you do it promptly. Consistency in your actions builds credibility and trust. Investors need to feel confident that you're reliable and capable of delivering on your promises. Celebrate the wins together. When your business achieves a significant milestone, share the celebration with your investors. Whether it's a major product launch, reaching a revenue target, or closing a big deal, acknowledge their role in your success and express your gratitude. A simple thank you note or a small token of appreciation can strengthen the bond and make them feel valued. Building relationships with investors is an ongoing process. It requires effort, transparency, and mutual respect. Remember, investors are not just sources of capital. They are partners who can provide invaluable support and guidance as you grow your business. In the next segment, we'll dive into how to prepare for investor meetings and present your business in the best possible light. Stay tuned and let's continue this journey toward securing the investment your startup needs to thrive. Congratulations on building those initial relationships. Now it's time to take things to the next level and prepare for those crucial investor meetings. This is where you'll have the opportunity to showcase your startup in person or virtually and make a lasting impression. Let's ensure you're fully prepared and ready to shine. First things first, know your audience. Before the meeting, take the time to research the investors you'll be meeting with. Understand their background, investment history, and what they're passionate about. Knowing these details can help you tailor your presentation to address their interests and concerns directly. For example, if an investor has a strong track record in tech startups, emphasize the innovative aspects of your technology and how it aligns with current market trends. Presentation and preparation is key. Start by organizing your materials. Your pitch deck should be polished, concise, and visually appealing. It should cover all the essential aspects of your business, including your mission, market opportunity, product, business model, team, financials, and the amount of funding you're seeking. Practice your pitch until it feels natural and confident. Rehearse in front of colleagues, mentors, or even in front of a mirror. The more comfortable you are with your material, the more confidently you'll present it. When the day of the meeting arrives, be punctual. Arriving on time, or better yet, a few minutes early, shows that you value their time and are professional. If the meeting is virtual, ensure that your tech setup is flawless. Check your internet connection, camera, and microphone ahead of time to avoid any last-minute technical glitches. Dress appropriately for the occasion. While startup culture can be more casual, dressing professionally for an investor meeting demonstrates respect and seriousness. Your attire should reflect your company's culture while still being business appropriate. During the presentation, start strong with a compelling introduction. Briefly recap your story, emphasizing the problem you're solving and why it matters. This sets the stage and grabs their attention. Keep your presentation engaging by using visuals, demos, and even customer testimonials if applicable. Remember, storytelling is powerful. Weave your narrative in a way that resonates emotionally with your audience. Be ready for questions. Investors will likely have a lot of them, ranging from your financial projections to your market strategy. Anticipate these questions and prepare thoughtful, concise responses. If you don't know the answer to a question, it's okay to admit it and offer to follow up later. Honesty is always better than trying to bluff your way through. Engage with your audience. Make eye contact. Use positive body language. And listen actively. Show that you're not just there to talk to them, but to have a meaningful conversation. Be receptive to their feedback and demonstrate your willingness to learn and adapt. After your pitch, steer the conversation towards how the investors can add value beyond just capital. Discuss their potential involvement in strategic decisions, their network, and how their experiences align with your business goals. This not only shows that you're looking for a true partner, but also allows the investors to envision their role in your success. Follow up promptly after the meeting. Send a thank you email expressing your appreciation for their time and reiterate your excitement about the potential partnership. Include any additional information they requested and restate the next steps you discussed during the meeting. This follow-up shows your professionalism and keeps the momentum going. Remember, each investor meeting is an opportunity to learn and improve. Reflect on each meeting. Note what went well and identify areas for improvement. Continuous learning and adaptation are key to refining your pitch and approach. In the next segment, we'll discuss how to navigate the final stages of securing investment, including understanding term sheets and negotiating deals. Stay with me and let's continue moving towards securing the funding your startup needs to thrive. You've made it this far, and now it's time to seal the deal. Closing the investment round is an exhilarating yet delicate process that requires careful negotiation and mutual understanding. Let's dive into the steps you need to take to successfully close the deal and secure the funding your startup needs. First, let's talk about the term sheet. A term sheet is a non-binding agreement that outlines the basic terms and conditions under which an investment will be made. It's crucial to understand every detail in this document. Don't hesitate to ask questions or seek legal advice to ensure you're fully aware of what you're agreeing to. Key components of a term sheet include valuation, investment amount, equity stake, board composition, liquidation preferences, and anti-dilution provisions. Each of these elements can significantly impact your business, so take the time to understand them thoroughly. Valuation is one of the most important aspects. It determines how much of your company you're giving up in exchange for the investment. While a high valuation can be flattering, it's essential to balance it with realistic expectations for growth projections. Overvaluation can lead to future funding challenges, while undervaluation can dilute your ownership too much. Aim for a fair and achievable valuation that reflects your startup's current and potential value. Equity stake refers to the percentage of your company that the investor will own. This directly correlates with your company's valuation and the amount of funding you're receiving. Be mindful of how much equity you're willing to part with and the long-term implications for your control and decision-making power within the company. Board composition and control rights are critical as well. Investors often want a seat on the board to oversee their investment and provide guidance. It's essential to have a balanced board that represents both the founders and the investors. This ensures that decisions are made in the best interest of the company as a whole. Liquidation preferences determine how proceeds from a sale or liquidation of the company are distributed. These preferences can affect the amount of money founders and early employees receive in the event of an exit. Make sure you understand these terms and how they align with your long-term goals. Once you've thoroughly reviewed and understand the term sheet, it's time to negotiate. Negotiation isn't about winning or losing. It's about finding a mutually beneficial agreement. Approach negotiations with transparency and a collaborative mindset. Clearly articulate your needs and concerns, and be willing to listen to the investor's perspective. The goal is to reach an agreement that aligns with both parties' interests and sets the stage for a successful partnership. After finalizing the term sheet, you'll move on to the due diligence phase. This is where the investor will closely examine your company's financials, operations, legal standing, and market potential. Be prepared to provide detailed documentation and answer any questions they may have. Transparency and organization are key during this phase. Having your financial records, legal documents, and operational details in order can expedite the process and build trust with the investor. Assuming everything checks out during due diligence, you'll proceed to the final agreement, also known as the closing. This is where the investment terms are legally formalized and the funds are transferred. It's a momentous occasion that marks the beginning of a new chapter for your startup. Celebrate this milestone with your team and take a moment to appreciate how far you've come. But remember, securing funding isn't just the beginning. It comes with the responsibility to deliver on your promises and grow your business. Keep the lines of communication open with your investors. Provide regular updates and seek their advice when needed. They're not just financiers, they're partners in your journey. In conclusion, closing the deal requires a mix of careful preparation, clear communication, and strategic negotiation. By understanding the terms, negotiating effectively, and maintaining transparency, you can secure the investment that will help your startup thrive. Stay dedicated and stay passionate and keep pushing forward. Your entrepreneurial journey is just getting started, and the best is yet to come. We've reached the end of another insightful episode of Full-Time Hustler. Today we've navigated the complex yet rewarding journey of finding and approaching investors. Let's take a moment to recap and reflect on the key takeaways from our discussion. Understanding the investor landscape is your first step. Recognizing the differences between angel investors, venture capitalists, and private lenders helps you tailor your approach and strategy. Each type of investor brings unique value and perspectives, and aligning your startup's needs with the right type of investor is crucial. Researching potential investors is where the real work begins. Utilizing online platforms, leveraging your network, and attending industry events can help you identify investors who are not only interested in your industry, but are also passionate about your vision. Personalizing your outreach and crafting the perfect introductory email can make all the difference in capturing their attention. Crafting a compelling pitch is an art. It's about telling your story in a way that resonates emotionally and intellectually with investors. Highlight your mission, the problem you're solving, and your unique solution. Be transparent about your business model, market opportunity, and financial projections. Remember, investors are not just investing in your product, but in you and your team. Making initial contact requires a strategic approach. Personalization, professionalism, and persistence are key. Whether through email, social media, or networking events, the goal is to make a strong first impression and open the door to further conversations. Building relationships with investors goes beyond the initial contact. It's about authenticity, consistent communication, and mutual respect. Keep investors engaged with regular updates, seek their advice, and show genuine interest in their perspectives. Building a strong, trusting relationship can lead to ongoing support and partnership. Preparing for investor meetings means knowing your material inside and out, presenting confidently, and engaging in a meaningful dialogue. Be ready for questions, listen actively, and demonstrate your commitment to your vision. Each meeting is an opportunity to refine your pitch and build stronger connections. Closing the deal involves understanding and negotiating term sheets, going through due diligence, and formalizing the investment. It's a process that requires careful attention to detail and a collaborative mindset. Remember, securing funding is just the beginning. It's the start of a partnership that can propel your startup to new heights. I hope this episode has provided you with valuable insights and practical strategies for finding and approaching investors. The journey of entrepreneurship is filled with challenges, but with determination, preparation, and the right support, you can achieve your goals. Thank you for joining me on Full-Time Hustler. If you've enjoyed this episode, please subscribe, leave a review, and share it with your network. Your support helps us continue to provide valuable content to entrepreneurs like you. Remember, we're in this together. Let's continue to hustle, innovate, and create a brighter future for our businesses and our communities. Until next time, keep hustling, stay passionate, and never stop believing in your vision. This is Jason Feimster signing off. Keep pushing forward, and I'll see you in the next episode.